Ladies and gentlemen, thank you for joining us today and welcome to our firm's Investing in India program and the 18th webinar in the series. My name is Karun Karyappa and I'm a partner at Kaitan's Corporate and Commercial Practice Group. I would like to extend a very warm welcome to every one of you wherever you are around the world. Investing in India is a webinar program curated especially for existing and prospective foreign investors to enhance their understanding of key issues with doing business in India. The program seeks to cover, over time, all issues of interest to our target audience. Before my colleague Susanna takes you through this presentation, I want to spend a few minutes setting the scene, because in this area of law, context is everything. Anti-bribery and anti-corruption diligence has for too long been treated as a peripheral concern in Indian M&A transactions, a box to tick. That approach is no longer tenable. The question is no longer whether to conduct ABAC diligence. The question, and this is what today's session is really about, is how do we calibrate risk without killing deals? Let me give you the Indian context. India presents a distinct set of risk factors that make ABAC diligence both more complex and consequential than in other jurisdictions. Businesses here routinely interact with government authorities across central, state, and local levels for licenses, permits, approvals, land rights, and public contracts. In sectors such as infrastructure, defense, pharmaceuticals, real estate, and natural resources, that interface with government is not incidental, it is structural. Add to this the role of third parties, agents, intermediaries, channel partners, consultants, who frequently sit between the business and the government official. Then consider payment patterns, success fees tied to regulatory outcomes, cash-based transactions, off-balance sheet arrangements. What does the law say? Indian law is very clear. The Prevention of Corruption Act of 1988 criminalizes both the giving and receiving of bribes, including, importantly, bribes given by commercial organizations. Prosecution risk is real. Layered on top are the FCPA and the UK Bribery Act, each with aggressive enforcement histories. A buyer who closes without adequate ABAC diligence is not merely taking on a contingent liability. In the worst cases, they are stepping into an ongoing violation. Against this backdrop, this presentation today will take you through three areas. First, where ABAC risk actually hides in Indian transactions, the government touchpoints, the third-party relationships, and the payment patterns that deserve scrutiny and often do not get it. Second, how to calibrate diligence so that it is proportionate, because not every risk warrants the same response, and a diligence process that treats everything as a crisis will either miss what matters or bring a transaction to its knees. Third, how to convert findings into deal protections and post-closing actions, because the output of ABAC diligence should not simply be a risk register. It should be a roadmap for pricing, for structuring indemnities, for conditions precedent, and for the integration program that begins the morning after closing. On this slide is the agenda for today's program. If you do have questions, please submit them using the facility provided in the webinar portal. If we do not cover questions during the webinar, we will respond offline by email separately. Also, please note that a copy of the presentation, summary notes, and a recording will be sent to you after the webinar as a matter of course. Let me now introduce our speaker for today. All registered participants should have received an email with the resume of our speaker and myself, so I will keep the introductions brief. Our presenter today is Susanna Naushad. She is a counsel with the Dispute Resolution Practice Group. She specializes in white-collar crime defense and investigations and has over 11 years of experience in anti-corruption, anti-money laundering, government investigations, and regulatory compliance. She brings a unique perspective as she's worked with a leading US law firm and specialized in DOJ and SEC investigations pertaining to the Foreign Corrupt Practices Act and sanctions-related issues. I would like to now invite Susanna to present.
Thank you so much, Karun, for setting the tone so well and for your kind introduction. Hello, everyone, and thank you all very much for joining us today. As Karun mentioned, the central question we are trying to answer is this: how do we calibrate risk without killing deals? Now, in the Indian context, ABAC risk is rarely addressed by simply doing more diligence. In practice, most transactions move under tight timelines and commercial pressure. The real challenge, therefore, is not to pursue perfection, but to focus diligence in the right areas, identify the red flags that truly matter, and then use practical deal tools such as conditions precedent, contractual protections, and post-closing remediation to manage those risks and still get the deal done. In other words, our goal is proportionate diligence and smart structuring, not theoretical perfection. Before getting into the mechanics of ABAC diligence in India, I want to briefly step back and frame the discussion in the broader context of cross-border investment and risk. One of the most important lessons for businesses today is that they need to know not only the target that they're investing in, but also the ecosystem around it, including business partners, intermediaries, subcontractors, and ownership structures. That becomes even more important when the transaction has a US nexus or other international exposure. For example, a connection with the US can bring with it significant litigation, sanctions, and regulatory risks, sometimes in ways that go beyond a company's own conduct. In certain cases, in fact, a target's compliance failures or sanctions exposure can effectively become the investor's problem. And this is why diligence becomes so important for investors, not just at the entry stage, but also at the expansion stage, when companies enter new markets, engage new intermediaries, and acquire fresh liabilities. Against that background, what I will be covering today is the following. First, why ABAC diligence is so important in India deals, including the potential exposure under Indian law as well as extraterritorial regimes. Second, how issues typically surface in India and the ways in which corruption and compliance concerns often present themselves in practice. Third, we'll speak about the successor liability risk and why an acquirer or investor cannot assume that historic misconduct will remain ring-fenced. Fourth, we'll look at how to calibrate ABAC diligence, including by looking at government touchpoints, sector-specific risk, and the degree of control or the structure of the investment. Fifth, we'll delve into how to actually conduct the ABAC diligence in practice, including the risk assessment process, common red flags we tend to see, and the transaction-specific remediation measures that can be built in. I will then touch on certain remediation tools and deal protections, including representations and warranties, indemnities, conditions precedents, and covenants. Finally, I will close with a few practical takeaways on how investors can manage ABAC risk in India in a commercially workable way. With that, let me begin with why ABAC diligence is essential in India deals. Next slide, please. India is widely viewed as one of the world's largest and fastest growing major economies, and it continues to attract long-term capital despite volatility cycles. For investors, the opportunity lies not just in the market size. It's the large domestic consumption, expanding infrastructure, digital progress, and manufacturing capacity. And therefore, we've seen that both strategic and financial sponsors are building platforms in India, not just making one-off investments. Some of the sectors where we've seen massive foreign investment include infrastructure, manufacturing, technology, pharmaceuticals, healthcare, and the financial services. However, although India is a high opportunity jurisdiction, it can also be high risk for corruption related issues because many businesses in India operate in a high touch environment. When I say high touch, I mean government touch points, which means execution in several sectors depends on frequent interaction with government departments, local authorities, PSUs, and regulators because of permits, inspections, renewals, procurement processes, land-related clearances, or routine operational approvals. In that environment, risk tends to sit in the points of friction. So the intermediaries who sort of handle relationships, the approval timed payout bucket, like we see in the real estate sector, or the informal practices that sometimes are just treated normally locally, like facilitation payments. For an international investor, the practical challenge is that these risks may not be visible in a target's written policies or leadership assurances, and that they can surface years later through whistleblower letters, tender challenges, PSU vigilance references, or investigations into public servants. And this is why ABAC diligence becomes so important. So when we are doing an ABAC diligence, we look at what is the operating model risk, what are the red flags, and how can this be controlled post-closing. Thus, in practice, ABAC diligence is serving both a legal and a commercial purpose. Legally, it helps the investor identify exposure under Indian law and, where relevant, even extraterritorial regimes. And commercially, it protects value by preventing unwanted surprises that can derail the deal. As a result, more and more international investors have become far more focused on ABAC diligence at both the entry and expansion stages. At entry stage, whether it's the first platform acquisition or a JV or a strategic stake, investors are trying to avoid buying an operating model that only works because someone knows how to navigate the system. On the other hand, at the expansion stage as well, the risk profile can also change quickly. New states, new permits, new tenders, new government-facing lines of business, or even new intermediaries can introduce corruption risk, even if the initial platform looked manageable. Now, we spoke about how ABAC diligence can help identify exposure under Indian law and extraterritorial regimes. So let's talk a little bit about that. Next slide, please. So when we're looking or we are doing the ABAC diligence for international investors in India, we don't just look at whether the target has a policy, because let's be honest, everybody has paper policies. We try and find whether the investor is inheriting a revenue model or a project pipeline that is dependent on improper government-facing conduct, and whether that legacy can trigger parallel exposure under Indian law and also extraterritorial regimes like the US FCPA and the UK Bribery Act. In M&A transactions, Indian and foreign anti-bribery laws can get attracted, and regulators don't just look at who owned the company when the wrongful payment was made. They look at what misconduct already existed in the target. They look at whether the acquirer inherited the entity and its liabilities. And they also look at what the acquirer did after signing or closing to stop and prevent the recurrence of misconduct. And therefore, remediation becomes very important for the investors. Practically, Indian law exposure in these cases typically comes through a combination of 4 legislations. The first is the Prevention of Corruption Act. So where an intermediary or an employee pays a benefit to a public servant in lieu of a government approval, the Prevention of Corruption Act will kick in. The second is the Indian Penal Code, or the new BNS. The same fact pattern can also attract offenses under the IPC or the BNS, such as cheating and criminal conspiracy, particularly where inflated invoices, sham contracts, or false documentation are used. The third is the Companies Act, which comes into the picture in cases of falsification of accounts, corporate frauds, internal audit issues, etc. Fourthly, and most importantly, if the proceeds are layered, say the success fees has been routed through multiple entities, or funds have been used to acquire land or property or move through related parties, the matter can also attract Prevention of Money Laundering Act scrutiny, because the enforcement agencies like ED may follow the money trail and they treat assets linked to suspected bribe proceeds as tainted. Companies may also have extraterritorial exposure. So we will speak about the US FCPA and the UK Bribery Act. The US FCPA, the Foreign Corrupt Practices Act, is one of the most actively enforced anti-bribery laws globally. It prohibits bribery of foreign officials by US persons and companies, of course, but it can also apply to non-US companies that are listed on the US exchanges or if they have a sufficient US nexus. Now, US nexus is a very broad term. So any transaction that's routed through the US linked systems or any group with US operations and consolidated reporting will fall within the purview of US nexus. So in practice, this gives the FCPA a very broad reach. Now, FCPA has 2 main provisions. The first is the anti-bribery provision, which prohibits the bribery of foreign officials. And the second is the books and records or internal controls provision, which is often the bigger problem in acquisitions, because if you acquire a business with weak controls, and if you keep running it without remediation, the regulator can view that as a continuing internal controls failure and take action. On the other hand, Under the UK Bribery Act, exposure is even broader in some respects because it captures both public and private bribery, and it penalizes corporates carrying on business in the UK for failure to prevent bribery. So if a US connected investor acquires an India business and that business uses agents or intermediaries who end up making improper payments, the question the regulator asks is whether the investor had adequate procedures and whether it rolled the adequate procedures out and enforced them post-closing. So essentially, today investors are not just expected to diligence Indian law compliance. Investors are also diligencing whether the India assets will create FCPA or UK Bribery Act exposure through third-party conduct and weak controls. Next slide, please. What makes ABAC diligence even more important in practice is that in India, issues often surface long after the improper payment was made. This is why investors need to dig deeper to ensure that historic conduct at the target does not later translate into liability or disruption for the investor. In our experience, issues typically emerge through a few recurring channels. First and the most common being whistleblower letters or emails. Now, whistleblower letters and emails usually surface after employee exits or internal disputes and often point to intermediaries, approvals, or payment practices that were never formally documented. Second, issues can also come to light when a public servant is investigated. And that investigation expands to identify the private parties and third parties who also allegedly benefited from or facilitated the conduct. Thirdly, tender challenges also sometimes become a trigger. So where competitors or PSUs scrutinize bid eligibility, pricing, certifications, or agent involvement, and allegations escalate into vigilance or investigative press references. Fourthly, sometimes issues also surface when internal emails or messages are discovered in unrelated proceedings, such as tax, corporate fraud, or employment disputes, revealing discussions around approvals or relationship management or just unusual payments. And lastly, competitor complaints can also initiate the process, particularly in regulated sectors and public procurement, where a complaint to a PSU or a regulator can quickly lead to scrutiny of the company's payment trails and third-party arrangements. When these issues surface, they rarely remain neatly confined to the old owners. They become an operational continuity problem for the buyer, and in a share acquisition especially, they can translate into a successor risk issue because the acquired entity remains the same legal person that is being scrutinized. Next slide, please. Now let's look at what successor liability looks like in practice. Investors often ask whether there will be successor liability for their transactions, and the answer in most of the cases is yes. Because under Indian law, in a share purchase acquisition, you are buying the same legal entity that made the payments, kept the books, and maintained the relationships. So if there was a bribery linked to public servants, say payment routed through consultant to obtain a permit or pass an inspection or just to secure a PSU tender, the target can remain exposed under the Prevention of Corruption Act and the Prevention of Money Laundering Act even after the shareholder changes. For the investor, this means that historic misconduct can become a post-closing continuity problem, leading to loss of management time, reputational fallout, disruption with the PSUs or regulators. We have seen cases of debarment also. And in money trail cases, it leads to the risk of attachment and confiscation actions that hit operations and financing. Separately, as I mentioned before, under extraterritorial regimes like the FCPA and UKBA, acquirers can face exposure where either they fail to do reasonable pre-acquisition diligence or they fail to integrate and uplift controls and just allow problematic conduct to continue post-acquisition. And therefore, ABAC diligence becomes important, or it is so important because it helps us understand the exposure. It helps us understand what the investors are inheriting at signing, what can become their problem after closing if the operating model remains the same, and how to protect value without killing deal momentum. We typically proceed with the deal if we think that the issue is containable and the operating model can be made compliant without killing revenue. On the other hand, we pause or walk away from the deal where the business depends on opaque intermediaries, facts are suppressed, or management will not change. Next slide, please. Let's move on to how we can calibrate the ABAC diligence exercise. Now, most people just assume that the scope of ABAC diligence is driven by deal size, but that's actually not true. In most India deals, scope is driven by three variables that matter far more than deal size: government touchpoints, sectoral risk, and control or structure, which means whether you can change the operating model post-closing. Let's start with the first one, which is government touchpoints. So if a target's revenue is dependent on licenses, regulatory approvals, inspections, or concessions, diligence must go deeper even if it is a smaller deal. In other words, a high-touch 300 crore transaction may need deeper ABAC diligence than a low-touch 3,000 crore transaction because the risk profile is different. Enhanced diligence is triggered when initial findings suggest that the business is being run through a high-risk channel. So certain red flags that we see are basically patterns. So consultants being tied to approvals without any real scope of work, excessive commissions or distributor margins, approval-linked marketing or CSR or sponsorship spends, cash-heavy site expenses and reimbursements, or just sometimes a small set of intermediaries who handle everything, but they have very thin documentation around them. When these signals appear, the diligence plan shifts from document review to targeted testing through forensics, where we look at payment sampling, proof of service verification, and deeper third-party diligence. Next slide, please. The second variable that defines scope is sectoral risk. India has some high-risk sectors because of the high level of government touchpoints these sectors have. And therefore, just by being part of this sector, we need enhanced diligence for them. For example, both infrastructure and real estate are high-risk sectors in India because they are government-heavy, interface-heavy businesses. It means they don't just sell products, they are also securing approvals, land, they manage local bodies, inspections need to be navigated, and they're often dependent on PSUs or government-linked counterparties for these approvals. In infrastructure, the typical exposure is around concessions, clearances, inspections, completion certificates, right of way, and PSU procurement, all of which generate repeated interactions with public officials and project site stakeholders. This sort of interface creates a demand for intermediaries, like licensing agents, local consultants, or contractors, who are often paid for outcomes rather than transparent services. So from a diligence perspective, this is why infrastructure work requires us to map government touchpoints, not only at the headquarter level, but also the project and site level. In my experience for EPC businesses, we usually see minimal issues at headquarter, but site level, we usually find issues, which becomes an escalation point. Real estate is also high risk for similar reasons. It is driven by land and local permissions, where discretionary decisions and local practices are common. Land aggregation, title conversion, zoning, building permissions, environment and fire approvals, occupancy certificates, regularization, and municipal interfaces creates a dense web of approvals. So in practice, there will, or at least we have never seen a bribe payment entry directly. It's just a set of seemingly legitimate vendors like advisors, facilitators, sometimes they're called community consultants, who are paid in tranches that are linked to approval milestones and with limited evidence of actual deliverables, and that becomes the red flag. Because the real estate business is approval timed, there's often intense pressure to keep these channels intact even post-closing, which is why investors need to diligence whether the company can operate without these opaque intermediaries and whether the approval pipeline can withstand a compliance reset. If you think the business cannot function without these local practices in action, then it's probably best not to go ahead with the deal. Now, looking at some of the important sectors, manufacturing can be relatively lower touch when the business is private B2B, approvals are routine and standardized, and revenue does not depend on public procurement. However, manufacturing becomes high touch quickly when the plants or units are expanding across multiple states, where factory licenses, safety and labor inspections are needed, pollution control consents are needed, that there is customs and tax interfaces which are frequent and decentralized. Again, the risk here tends to sit at the site level in small repeated interactions and reimbursements rather than one big bribe payment that we will be able to see in their accounts. Pharma and healthcare is also similar in the sense that they look low touch on paper but become high touch depending on how the company sells and operates. So if the model is largely export driven or private hospital driven, the risk profile can be more manageable. But where The revenue depends on government tenders, sales to public hospitals, PSU procurement, licensing and product approvals, or regulator-facing interactions. The touch points increase substantially. In practical terms, the high-risk areas that we see in pharma or healthcare, they often sit in commercial buckets. So during the diligence, we look at the discounting model, we look at distributor margins, event sponsorships, and their interactions with hospital procurement committees, rather than the classic permit or facilitation spends. Next slide, please. The third variable that defines scope of diligence is the control and structure of the deal. Now, in a share acquisition deal, where we will get control of the company, the diligence is designed to identify few critical risks that must be addressed immediately, and the broader control uplift can be implemented after the closing, say through a credible 100-day plan to replace problematic intermediaries, uplift financial controls, and install investigation protocols. On the other hand, in a minority deal, however, because you cannot unilaterally change behavior because you don't control the company, diligence focuses on, firstly, whether the business relies on high-risk conduct to function, and secondly, and most importantly, what governance, information, audit, and veto rights the investor can get to prevent recurrence and detect issues early. Next slide, please. Now let's come to the issue of how to do an ABAC diligence properly. The most useful way to think about an ABAC diligence in India is not as a long process, but just as a targeted set of deal questions that tells you whether the business can run cleanly and what you need to hardwire into the transaction to make that happen. So in terms of the process of diligence, how do we start the process? We start the process by sending information requests to targets, and we try and identify the risk drivers. So just a few examples of the requisitions we call for are the compliance policies that the company has. We ask for the company's internal audits or reviews that are designed to identify the compliance with internal controls. We also ask for a list of governmental approvals obtained or required by the company to operate its business. Most importantly, we ask for details of any actual, pending, or threatened corruption allegations, kickback allegations, conflict of interest, improper gifts or hospitality, admissions-related misconduct, or procurement irregularities. We also ask for details of any litigation, arbitration, criminal complaints, regulatory actions, blacklisting, debarment issues, or any settlement involving corruption, fraud, misuse of funds, or abuse of office, and details of any expenses that were incurred by the company in promoting business or extending hospitality to government servants. All these examples are, of course, not exhaustive. We send a very long list. These were just some of the examples. Now, post-review of the documentation, if any red flags are found, we often dig deeper by bringing in forensic consultants because they add a level of independent, evidence-led testing, which checks whether the records and the data, they support the story, and they check where the money is actually going. Through these requisitions and forensics, we basically try and answer two threshold questions. The first question we try to answer is whether there are any issues that are already on the regulator's radar. Now, importantly, if the company is already facing CBI or ED proceedings, for example, there's an ongoing trial involving predicate offenses and money laundering, then the risk profile changes materially. At that point, there may already be reputational damage, and there is a real risk of attachment and ultimately confiscation of assets. In those cases, investors should think carefully about whether to proceed at all. Secondly, we look at the question of, even if the issues are not known to external regulators, we look at whether the red flags can be remediated without breaking the business. Now, some models are structurally dependent on opaque payments and intermediaries to secure approvals or win business. Where that is the case, the key diligence outcome is to determine whether the operating model can be reset to a cleaner approach without undermining revenue or execution. And if the answer is no to this question, then again, best to walk away. So this was broadly the process of diligence. Now let's come to the scope of diligence and what all comes within the scope. Next slide, please. So in terms of the scope of diligence, we usually map the company's government interface points, the intermediaries who deal with these touch points. We look at the spend buckets, like commissions, consultants, petty cash, and reimbursements. We also do a quick check for PEP related risk to understand whether promoter or key management connections can create influence based business advantages. Now, these issues crop up particularly in promoter led businesses or businesses that operate heavily in regulated or government linked ecosystems. In India, PEP linkage can arise through current or former public roles, political connections, or close associations like relatives being government servants in a position to influence approvals. Now, where a promoter or a key person is PEP linked, the diligence emphasis shifts to related parties, approval linked spending, tender history, and who handles government relationships, because these are the areas that are most likely to generate questions later as well. The purpose is basically to test whether the business is being run through relationship capital. Again, to clarify, the goal is not to avoid all PEP situations. It's not like if you have a close relative who's in a position of power in a PSU or a governmental body, it doesn't mean that you will never get a job. The goal is just to ensure that those PEP relationships are not being used in an inappropriate way. Now, moving on, in terms of scope, we also look at third-party and supply chain diligence. Because in India, ABAC risk frequently travels through intermediaries rather than direct payments. However, it's obviously not practical to diligence everyone. So we only diligence the third parties that matter. So any agents or consultants, distributors, licensing vendors, and contractors who interact with public officials or who have the power to influence approvals, tenders, or inspections. The question we are looking to answer is if the third party is legitimate, if they are being paid proportionately for real services, and if they can evidence what they are doing, which means can they provide proof of service. Where third parties fail these tests, that is where they indicate opaque ownership, PEP links, non-standard fees, unusual payment routing, no proof of service, we will eventually have to terminate or restructure them. Next slide, please. Now that we've looked at the process and the scope of diligence, let's look at some anonymized practical case examples of red flags we notice in our day-to-day diligence work. And if you have these signs in the target, then it's definitely a warning sign. The first is recurring consultant retainers with very thin scope, with no documentation in place to show actual service, and excessive commissions or distributor margins around government business approvals. This is the first red flag we see. Another example we see is license renewal risk hidden in facilitation reimbursements. So in some regulated businesses, the target's compliance story looks clean at the policy level because they have all the policies in place, but the payment trail shows recurring employee reimbursements around license renewals, inspection cycles, or site certifications. Now, these amounts are often small and frequent, and they are disguised as meeting expenses, documentation costs, local license, and they sit across multiple locations, which makes them easy to miss in a standard legal diligence. Now, if these costs or meeting expenses have no documentation surrounding it, and these happen to be very close to a license approval or renewal time, that becomes a cue to check deeper. Another common pattern we have noticed is last-minute vendor onboarding and frequent bank account changes. So for a matter we were doing, we saw repeated last-minute vendor additions, incomplete KYC for those vendors, and multiple bank account changes shortly before the payments were being processed. The invoices looked ordinary, so they were invoices for civil works or logistics support or consulting, but the control environment suggested a system that these payments were being made as kickbacks. So we eventually fixed this through conditions precedent that implemented vendor master controls and post controls uplift. Another example we see is CSR or charitable donations being used as proxy for local influence. So in certain sectors, especially those with site presence, the company's CSR donations and sponsorship spends become a subtle but meaningful risk channel. These payments are usually defensible on paper because they're for community welfare or local development. It will be in the form of a sports sponsorship. But diligence shows that if the diligence is showing that they cluster around key approvals, land issues, local protests, or regulatory friction points, then it's definitely a red flag. The counterparties in this situation can, we've seen counterparties being local trusts or NGOs with limited transparency. And approval processes for these spends were also informal, which was again a very big red flag. The next example, which we basically see often, or it's almost a pattern, it's a subcontracting chain, which masks who actually performs the work, because then payments move away from traceability. So in this situation, a legitimate primary contractor subcontracts to another entity, and that entity again subcontracts further, sometimes to small vendors with weak documentation. By the time the payments reach the last link in the chain, the company has very little line of sight on who is performing the work or where the money ends up. Another example is customs or logistics interface. So, import heavy businesses, a key risk channel is the customs or logistics interface, where the company relies heavily on a clearing agent or a logistics partner, and which creates a risk that improper payments are being made in the background to avoid delays or scrutiny. And the last example is company hiring advisors, who are basically just individuals with strong local influence for roles that do not have any clear responsibilities or performance metrics. Compensation in these cases may be structured as consulting fees or high retainers, and the business justification is often that they help with relationships. This becomes risky when the role is essentially an influence conduit rather than a genuine commercial function. Now, all of these above examples underline the same core point, that ABAC diligence is not about finding a bribe entry. Like I said, there will never be an entry for bribe. It's always about identifying whether the business relies on channels that are hard to defend, like weak procurement controls, opaque CSR spends, uncontrolled subcontracting, miscellaneous charges, or these influence-based advisor roles. And then when we find these legacy issues, we use deal protections and post-closing controls to make the operating model clean in practice. So, those were some legacy issues that, we've often seen cropping up in diligences. This takes us to the next question, which is when these issues are identified, what happens to the diligence process? It doesn't automatically mean that the deal must fall through. So from here, we focus on transaction-specific remediation, depending on what level of control the buyer has. Next slide, please. Now, in a control acquisition, the diligence then focuses on separating what must be fixed immediately from what can be addressed through integration. So we identify certain critical issues that need to be resolved at or before closing, and then we rely on a credible 100-day remediation and integration plan to complete the broader controls uplift post-closing. In a joint venture, the objective is to put clean operating rails in place from day one and prevent one partner's local practices from contaminating the venture. If it's a minority investment, you typically cannot fix operations post-closing through management control. So diligence is dependent on testing whether the business is dependent on high-risk conduct to function. And the deal then needs to secure, the deal is basically then to secure the right levers. So for example, information rights, audit rights, approval or veto rights over high-risk areas, so that the investors get the power to detect issues early and block recurrence after they invest. Next slide, please. Coming to our last segment, let's see how we can put these transaction-specific remediation into action and what are the deal protections we can get. Now, ABAC diligence only creates investor value if it translates into binding deal protections and a realistic remediation plan. The goal is to allocate risk in a way that is enforceable and commercially workable. And for that, we always use a layered toolkit. The first is reps and warranties, which to flush out facts. The second is indemnities to allocate known risk. And third is conditions and covenants to force remediation. Next slide, please. At the contractual level, well-drafted reps and warranties are primarily a disclosure tool. They force the seller to confirm specifically whether there have been any improper payments or government investigations, any tender-related allegations, material use of agents for government interfaces, or internal audit whistleblower issues, and whether books and records accurately reflect payments. In an Indian context, the most useful reps are not the generic, we comply with the law sort of statements. The reps should be tailored to the business model, and the representation should also include representations on PSU and tender history, approvals and licensing. There should be representations on the use of intermediaries, on discounts, commission structures, and any government touch points that drive revenue. These reps matter because they create leverage if facts later emerge that were not disclosed to us. Indemnities, on the other hand, allocate residual risk. Conceptually, we need to treat ABAC risk differently from ordinary commercial risk. And general indemnity caps often do not fit ABAC exposures because the downside is frequently hard to quantify upfront in cases of, if there's an investigation or a disruption, if there's a debarment risk or a remediation cost. So practically, investors should seek special indemnities for specific identified ABAC concerns, sometimes supported either by escrows or holdbacks or negotiated carve-outs. Ordinary caps may not work in this situation. Thirdly, conditions precedent are a way to manage legacy conduct. So we either terminate or we repaper the intermediary, we implement payment controls, complete a targeted investigation, or remediate a known control gap before closing. Where pre-close remediation is not realistic because of either time, lack of time, or business continuity, we convert it into remediation undertakings with timelines and deliverables. So with that, we have reached the end of our presentation, and thank you very much for your patience. In the end, I would just like to leave you with 4 practical takeaways. Next slide, please. So the first practical takeaway is that ABAC diligence in India is about getting the level of checking right, not proving that the target has always been perfect. Our aim is to find where bribery risk can happen and then decide clearly what must be fixed before closing, what should be covered in the deal terms, and what can be cleaned up after closing. The second practical takeaway is that in practice, sector and government interaction matter more than deal size. So a smaller investment in infrastructure or real estate can be riskier than a much larger low-touch private B2B deal because these sectors rely on permits, inspections, land, and local clearances. Deal value may affect how much time and sampling we can do, but the risk profile should drive the scope. Thirdly, starting early helps because early diligence gives us more options. If issues show up late, we often only have 2 choices. We can either delay the deal or take the risk. If issues show up early, we can structure solutions without losing momentum. And fourthly, and the most important takeaway, is that India risk can be managed, but only if you deal with it deliberately. Most ABAC risk is controllable through the practical steps that we have outlined in the presentation, which is mapping key touch points, controlling intermediaries, tightening payment approvals, setting up monitoring and response processes after closing. What causes avoidable damage is treating local practices as unavoidable, relying only on paper policies and not turning diligence findings into real deal protections and operational changes. Thank you so much. That we have finished the presentation. Back to you, Karun.
Thank you, Susanna, for that really interesting presentation. There are a few questions that I believe are pertinent. What are deal breaker red flags? When do you actually walk away?
Thanks, Karun. So, we don't walk away just because a red flag exists. We walk away when either the risk seems structural, the facts are not reliable, or we think remediation is not realistically achievable. The clearest deal breaker is when the company's core revenue or approvals pipeline appears dependent on a high-risk channel, especially in PSU or tender-heavy businesses, and the management has indicated either explicitly or implicitly that those channels cannot be changed. So if the business only works because a particular intermediary is the reason for approvals, and the investor cannot replace that with a compliant model without collapsing the revenue, then it means that the issue isn't historic. It's just built into an operating model and it cannot be remediated. So that's our cue to sort of walk away. Second, we walk away if there is no integrity of disclosure. So if we can't get the facts, we cannot calibrate risk. So for example, if there is refusal to share the details of third-party intermediaries or inconsistent explanations for the same spend bucket, incomplete supporting document, or just late-stage surprises that should have been disclosed earlier, like for example, an old vigilance complaint or a tender dispute or a regulatory query, then it's our cue to walk away because it means information is not being shared transparently. Thirdly, as I mentioned before, if there is an active, serious investigation, then I think the investor should really consider whether they want to proceed at all. So if there's an ongoing matter with high probability of operational disruption, for example, a CBI and/or an ED inquiry, that could plausibly lead to freezing or attachment or confiscation of property, then investors have to decide whether they want to inherit that. So, I mean, overall, the rule of thumb is that we proceed where the issue or red flag is containable and remediable. Otherwise, I think it's just better to walk away.
Fair enough. Now, we have another sort of follow-on question from a compliance perspective. Are we required to self-report what we find in diligence?
So under Indian law, and thank you for that question, it's very important. Under Indian law, as a general principle, there is no automatic requirement to report issues simply because you have discovered them in a pre-acquisition diligence. It's similar for internal investigations as well. And if some misconduct is discovered during an internal investigation, you don't have to self-report. A diligence is a confidential exercise and it's conducted for risk assessment. There is no general obligation, but it is important to check the fact pattern. So in certain cases, for example, if the target is listed, material events will need disclosure. Also, under the Companies Act, auditors have their own reporting obligations in particular circumstances. So for example, if they discover a fraud over 1 crore rupees, then they have to report to the central government. Even sectoral regulators may require reporting of certain events in regulated industries. And if there is already an active regulator engagement, if like, for example, the company is under scrutiny, then the strategy will be different. So, it basically depends on the fact situation. In fact, sometimes as part of our remediation strategy, it makes sense for us to go and do a controlled engagement with the regulator. Sometimes, we do that to present or to preserve tender eligibility. And sometimes we do that to, say, avoid debarment. In those cases, the engagement should be careful and, of course, fact-based. So to answer the question, I mean, diligence findings do not automatically require disclosure, but it is important to assess the specific statutory or contractual, regulatory, or even stakeholder triggers before deciding whether and how to engage.
Oh, understood. I think that's quite relevant and quite pertinent. Now, during diligence, if we find a high-risk intermediary, what are your realistic options other than termination?
So termination, of course, is sometimes necessary, but I mean, as lawyers, we also understand that it's not always commercially viable. Another practical option is to repaper the intermediary, which just means that we rework the agreement with the intermediary. We tighten the scope of work, we exclude vague relationship management scope, we require measurable deliverables, we fix the compensation from them, and so we move away from the success fee or outcome-linked payments. We impose proof of service rigor, which means that we provide for invoices to be specific, supported, and approved by the right signatories. We put restrictions on subcontracting. We also, constantly perform due diligence on the vendor, at least on an annual basis. And of course, in the contract, we also prohibit the intermediary from making any commitments or payments on the company's behalf. So that is one option, to repaper or rework the contract with the intermediary. The second practical option is sometimes, ring fencing, which means that we continue the relationship temporarily, but under heightened monitoring until the investor can build an alternative vendor pathway. So this ring fencing sort of helps when immediate termination is not an option because it would disrupt operations, but you have the option to reduce the risk quickly and then eventually terminate them.
So, Susanna, we've heard a lot about forensic auditors, and the role that they play when you're undertaking ABAC diligence. Can you give us a brief overview as to what is the interplay of a forensic auditor in a due diligence process, along with our due diligence process? When do they actually come into the picture, and at what point do we rely on them for their report?
Sure. So a forensic auditor sort of sits in the diligence process as the evidence and money trail. So legal diligence will tell you what the requisition documents say and what the management represents, whereas a forensic team tests whether the numbers, payments, approvals, vendor relationships support that story, and whether there are any problematic patterns that suggest improper payments or controls failures. So practically, they do the following. So they do data analytics on spend. They will review the ledger data. They will look for risk patterns. So round sum payments, split invoices, spikes around approvals or tenders, cash heavy categories, unusual consulting, miscellaneous expenses or marketing buckets, duplicate vendors, or frequent bank account changes. They also do third-party intermediary tracing, which means they validate whether the agents, consultants, vendors, or intermediaries are real. They identify related party linkages. They check for ownership or PEP connections, and they assess whether fees are proportionate to services. They also assess how vendors are onboarded, who can create vendors or change bank details. They look at segregation of duties and whether controls have been bypassed in practice. They do proof of service testing. So they sample invoices and test whether there's credible underlying documentation like statement of work, work orders, deliverables, timesheets, emails, and whether the approval trail makes sense. So that was the scope of what they do and how they can assist. In terms of when they come into the picture, we bring them in when the risk is high touch by design or when red flags suggest we need evidence-based testing to make the deal decision and structure protections. So, for example, in some of the high touch sectors like infrastructure or real estate, they are pre-planned from day one. Because it's often efficient to involve forensics early as the risk is expected and time is short. However, in most cases, the need is triggered by red flags during the legal diligence and after review of the requisition documentation. Forensics are typically brought in when we see patterns like opaque consultants tied to approvals with thin scope, or a lot of cash or reimbursements or miscellaneous spends. If we find unusual commissions or discounting around government or PSU business, if we find weak vendor onboarding or bank account change controls, or missing documentation or inconsistent management explanations, or of course, if there are whistleblower allegations or prior internal audit flags, that's when we bring them in. And that's our cue to kind of dig deeper into the numbers. A third possibility is when the deal terms depend on quantifying or ring fencing risks. So when we are negotiating conditions precedent or special indemnities, escrows, holdbacks, or a price adjustment, a forensic work stream helps us quantify exposure and define exactly what must be fixed. So yes, that's when they come into the picture, and that's the interplay.
Excellent. Thank you, Susanna. How about mistakes? I mean, obviously, having done a fair amount of M&A due diligence from an ABAC perspective, what are the most common mistakes that you've seen whilst undertaking such diligence?
So there are quite a few mistakes which should be avoided. I think the most common mistake is treating ABAC diligence as just a policy check rather than an operating model test. So, I mean, most targets have a code of conduct and they will have at least 10 policies in place. But just having paper policies is not enough, because the real risk is not, it sits in how the business is actually run. It's not about how many policies the business has, but whether those policies are being implemented or not. Another common mistake is diligencing the top vendors by spend, but not focusing on the most sensitive vendors by role, because that is where the risk is the highest. Thirdly, I think sometimes teams rely too much on the representations and management explanations and don't do enough targeted testing on their own when red flags appear. So it's important to keep in mind that ABAC issues are rarely admitted. You will never really see a target admitting that there are internal controls issues or they pay bribes or kickbacks. And these sort of payments are rarely labeled. So if we see problematic patterns like weak consulting fees or approval time spend hikes, cash heavy reimbursements, or very weak documentation, it is important to shift from document review to targeted testing through forensics. And lastly, we see a lot of investors mishandle the deal timeline. So as I mentioned in the takeaways, when diligence is delayed, the only choices then become delayed signing or accepting the risk blindly. And therefore, starting early is the best because starting earlier preserves the options.
Understood. Fair enough. Can you give us any examples of conduct that becomes an FCPA books and records problem?
Yes, so this is actually a very important question, and thank you for asking that. Under the FCPA, even if the regulator, which is the DOJ, cannot prove bribery, it becomes a books and records and internal controls issue if they find an accounting trail which is inaccurate or unsupported, and FCPA can be attracted. So in practice, FCPA books and records issues arise when their improper payments are recorded as, say, ordinary business expenses without accurately describing their purpose, and where internal controls are too weak to prevent or detect that. Common patterns in India include tender support or licensing charges, local handling, documentation fees, etc. Another example that we see is inflated or vague third-party invoices, which again becomes an accounting controls issue. Cash-heavy categories are also very common in India. So at the site level, we will see a lot of petty cash, reimbursements, miscellaneous spending. These amounts are they're individually small, but they're frequent, and they often correlate with local inspection cycles, licensing touch points, and that sort of makes them a classic internal controls risk. Then, of course, we have the risk of CSR or donations and sponsorships becoming a books and records issue when these payments are recorded as community or market spend, but if you check internally, they will correlate with approvals or land issues or local pressure points, and this is where due diligence and approval governance is weak. So, the practical takeaway is that FCPA exposure in acquisitions often doesn't start with a bribery finding. FCPA can be attracted even with mischaracterized expenses and weak controls. And that's why acquirer needs to focus so much on third-party controls and cleaning up spend categories quickly post-closing. Are there any other questions?
No, fair enough, Susanna. I think thank you very much. I think that we're almost out of time, so that was an excellent presentation, and thanks very much for giving us that excellent perspective. Now, our audience will separately receive a request for your feedback on the webinar. Please do take the time to send us your input, comments, criticisms, and even compliments. The form takes less than a minute to complete, so please do indulge us with your time. Thank you very much for your attendance today, and we look forward to being with you again.
Thank you very much, everyone. Thank you.